Imagine two people starting with exactly the same amount of money. They have the same salary, the same age, and the same dream of becoming wealthy. 20 years later, one of them owns multiple valuable assets, while the other has built a portfolio worth hundreds of thousands of dollars. The surprising part? Neither of them made a bad decision. Meet Jake and Marcus. Both have saved $50,000. Jake believes real estate is the fastest path to financial freedom. Marcus believes long term investing is the smarter choice. Both are confident, both think they're making the better decision, but only one question matters. Which strategy actually creates more wealth after 20 years? Let's start with Jake. He uses his $50,000 as a 20% down payment on a $250,000 rental home. The bank finances the rest through a 30-year mortgage. A few weeks later, he finds a tenant willing to pay $1,800 every month. On paper, everything looks incredible. His mortgage payment is lower than the rent he collects. Jake looks at the numbers and smiles. It feels like the house is paying for itself. Marcus takes a completely different path. He deposits the same $50,000 into a low-cost total stock market index fund. No rental property, no tenants, no mortgage, no phone calls. Then he sets up an automatic investment of $300 every month and simply lets time do the work. At first, Jake looks like the clear winner. He owns a real house, he has keys in his pocket. Friends congratulate him on becoming a landlord. Every month, rent arrives in his account, making the decision feel smarter and smarter. Marcus has none of that. All he sees is a number inside an investment account that moves up, then down, then up again. There's nothing exciting to show anyone, no impressive story, just patience. But investing isn't about looking successful today, it's about becoming successful years from now. And that's exactly where this story begins to change. Because the biggest difference between Jake and Marcus isn't the money they started with, it's the hidden costs, hidden risks, and hidden advantages that most people never calculate. Before we jump into the numbers, ask yourself one question. If you had $50,000 today, would you buy a rental property or would you invest every dollar into the stock market? By the end of this video, you'll know exactly which choice has historically created more wealth and why the answer isn't as obvious as most people think. Year one feels incredible for Jake. Every month, another rent payment lands in his bank account. Friends congratulate him for becoming a landlord. Every mortgage payment builds a little more equity, and nearby home prices continue rising. It seems like he made the perfect decision. Marcus has a very different experience. He opens his investment account once every few weeks. Some days it's up, some days it's down. Nothing exciting happens. His coworkers chase hot stocks and crypto trends, while Marcus quietly keeps buying the same boring index fund every single month. If you judge both investors after just 1 year, almost everyone would choose Jake's strategy. But wealth isn't built in 1 year. It's built over decades. By year three, the hidden reality begins to appear. Jake has collected thousands of dollars in rent, but the bills never stop coming. Property taxes, home insurance, routine maintenance, a leaking faucet, a broken water heater. 1 month without a tenant, every unexpected expense quietly eats into his profits. The rent checks still look impressive, but the money he actually keeps is much smaller than most people imagine. Meanwhile, Marcus hasn't answered a single phone call from a tenant. He hasn't dealt with repairs. He hasn't worried about vacancies. His portfolio simply keeps growing through consistent investing and compound returns. Around year three, his account reaches roughly $75,000, not because he found the perfect stock, not because he timed the market, but because he stayed consistent while everyone else searched for shortcuts. This is where most people make a huge mistake. They compare Jake's monthly rent to Marcus's investment balance. But those aren't the same thing. The real comparison is total wealth after every expense, every repair, every tax, every dollar invested, and every hour of work. And once you calculate everything, the gap becomes much smaller than most people expect. By year 5, Jake has become an experienced landlord. He's handled multiple repairs, dealt with difficult tenants, increased the rent, and watched his property appreciate in value. On paper, his investment looks stronger than ever. But behind the scenes, the workload has grown too. Weekend maintenance, late night phone calls, unexpected repair bills, insurance premiums continue rising, property taxes increase almost every year. Owning real estate is no longer just an investment, it's a business. Marcus is living a completely different reality. Every month, another automatic investment goes into his index fund without him doing anything. No meetings, no contractors, no emergencies, just patience. This is where compound growth starts becoming visible. The gains from previous years begin creating even more gains. His money slowly starts working harder than he does. By year 10, both investors have built impressive wealth. Jake's home has appreciated significantly, and years of mortgage payments have created a large amount of equity. Marcus's investment portfolio has also grown dramatically through consistent contributions and long-term market growth. For the first time, their total net worth is surprisingly close. Many people expect one strategy to completely destroy the other, but that's not what actually happens. Jake benefited from leverage. Marcus benefited from compounding. Both strategies worked. They simply worked in very different ways. But there is one difference almost nobody talks about. Jake earned every dollar while managing a physical asset. Marcus earned every dollar by simply staying invested. One invested time, the other invested patience, and over the next 10 years, that difference becomes impossible to ignore. By year 20, the results are finally clear. Jake's rental property has grown tremendously in value. His mortgage is nearly paid off or completely gone. He owns a valuable asset that generates rental income and has built substantial equity over 2 decades. That's a remarkable achievement. Marcus has also reached an incredible milestone. After 20 years of consistent investing, his portfolio has grown into hundreds of thousands of dollars. No tenants, no repairs, no late night emergencies, just the quiet power of time and compound growth. When you compare their total net worth, something surprising happens. They're much closer than most people expect. Real estate didn't completely crush the stock market, and the stock market didn't completely crush real estate. Both created wealth. They simply demanded different sacrifices. Jake accepted debt, responsibility, maintenance, and ongoing management in exchange for leverage and tangible assets. Marcus accepted market volatility, emotional discipline, and long-term patience in exchange for simplicity and flexibility. So, which investment is actually better? The answer depends on you. If you're comfortable managing properties, solving problems, and using leverage wisely, real estate can be an incredible wealth building tool. If you value simplicity, diversification, liquidity, and passive investing, index funds can be just as powerful over the long run. The biggest mistake isn't choosing real estate, and it isn't choosing index funds. The biggest mistake is making financial decisions based on headlines, social media clips, or someone else's success story without understanding the complete picture. Because real wealth isn't built by copying other people. It's built by choosing a strategy you can consistently follow for decades. So if you had $50,000 today, which path would you choose? Real estate or index funds? Let us know your answer in the comments. And if you enjoy simple, data-driven financial stories that break down money, investing, and wealth building without the hype, subscribe and join us for the next video.